Bitcoin is often compared to a Ponzi scheme, but it fundamentally differs in its structure, purpose, and functioning. Below is a breakdown of how Bitcoin compares to and differs from a Ponzi scheme. What is a Ponzi scheme? A Ponzi scheme is a type of fraud where returns are paid to earlier investors using funds from newer investors rather than from legitimate profits. Characteristics include centralized control. A single individual or entity orchestrates the scheme. Unsustainable model. The scheme collapses when new investments stop coming in. Guaranteed returns. Promises of consistent, high returns regardless of market conditions. How Bitcoin differs from a Ponzi scheme. Decentralization. Bitcoin. Bitcoin operates on a decentralized network without a central authority or single orchestrator. Transactions are validated by a global network of computers, miners. Ponzi requires a central operator who controls funds and payouts. No promised returns. Bitcoin. There are no guarantees of returns when you buy Bitcoin. Its price is determined by supply and demand in the market, and it can go up or down. Ponzi promises steady, often unrealistically high returns to attract new participants. Transparent system. Bitcoin. The Bitcoin blockchain is completely transparent. Anyone can audit the public ledger and track transactions. Ponzi operates in secrecy, hiding how funds are managed. Legitimate use cases. Bitcoin. Bitcoin can be used for legitimate purposes such as peer-to-peer transactions, remittances, and as a store of value like digital gold. Ponzi has no real products or services. It exists solely to funnel money to earlier participants. Sustainability. Bitcoin. Its longevity depends on user adoption, utility, and market dynamics. There's no inherent collapse mechanism like in a Ponzi scheme. Ponzi eventually collapses when new investors stop joining, as it relies on a constant influx of funds to sustain payouts. Why some compare Bitcoin to a Ponzi scheme? Speculative nature. Many people buy Bitcoin hoping its price will rise, akin to how Ponzi schemes attract participants with promises of gains. Dependence on new buyers. Bitcoin's price increases when more people buy it, which resembles the need for new investors in a Ponzi scheme. Lack of intrinsic value. Critics argue Bitcoin has no intrinsic value and its worth is driven solely by perception, making it seem pyramid-like. Key risks in Bitcoin, not Ponzi-related. Volatility. Bitcoin's price is highly volatile, which can lead to significant financial losses. Regulatory uncertainty. Governments may impose restrictions that impact its usability or convertibility. Fraud and scams. While Bitcoin itself isn't a Ponzi scheme, there are scams and Ponzi schemes that operate using Bitcoin as a lure. Conclusion. Bitcoin is not a Ponzi scheme because it lacks a central authority profiting from new participants. It does not promise returns or operate on deception. It has legitimate uses as a decentralized digital currency. However, its speculative nature and reliance on market demand can make it appear Ponzi-like to critics. It's more accurate to describe Bitcoin as a high-risk, speculative asset than a fraudulent scheme.